Silver just touched $94, and suddenly everyone is talking about one number like it's destiny: $100. Social media is flooded with charts, arrows pointing straight up, bold claims, and people saying this is the moment silver finally breaks free. But here's the uncomfortable truth that most hype videos won't tell you. The $100 level may not be a victory line. It may be a trap. And if you don't understand why that level exists, who benefits from it, and how markets behave around round numbers, you could end up celebrating right before the rug gets pulled. When silver moved past 90, the emotional shift was immediate. Doubt turned into confidence, and confidence quickly turned into certainty. That's how markets usually behave near major psychological milestones. The closer price gets to a clean round number, the louder the crowd gets. $100 isn't just a price, it's a story. And that's exactly why it deserves skepticism instead of blind excitement. Markets don't move in straight lines, especially not commodities with long histories of manipulation claims, leverage, and institutional control. Silver has always been volatile, emotional, and heavily traded on expectations rather than immediate physical demand. The run to $94 didn't happen in a vacuum. It came after years of suppressed pricing, inflation concerns, currency instability, and growing distrust in financial systems. Those are real forces, but when price accelerates this quickly, something else enters the picture: positioning. Large players don't chase price the way retail traders do. They plan levels months or years in advance. Round numbers like $100 are magnets for liquidity. They attract stop losses, take profit orders, breakout traders, and emotional buying all at once. That concentration of orders creates opportunity for those with enough capital to move the market temporarily against the crowd. This isn't conspiracy, it's basic market structure. When silver approaches a level like 100, two things usually happen at the same time. Retail interest spikes, and smart money starts preparing exits or hedges. Not because silver is suddenly worthless, but because risk to reward changes dramatically. Buying at 60 feels very different than buying at 98. At lower levels, downside is limited and upside feels open. Near 100, downside risk increases sharply, while upside becomes crowded with expectations. Another factor most people ignore is how futures markets influence spot price. Silver isn't just traded as physical metal. It's traded as paper contracts, many times larger than the actual available supply. When price nears major resistance, futures positioning becomes aggressive. Volatility increases. Sharp moves up and down happen within hours, not weeks. That environment punishes emotional decisions and rewards patience. The idea of a wall at $100 exists for a reason. It's not just psychological, it's historical. Every time silver has approached a major milestone, whether it was $20, $30, or $50, price didn't simply glide through. It hesitated. It spiked. It corrected, sometimes violently. The higher the expectations, the more dramatic the reaction when momentum stalls even briefly. This is where the trap forms. New buyers see 94 and think $6 more is nothing. They imagine easy upside. But markets don't care about what feels small or large. They care about positioning and behavior. If too many participants believe one outcome is guaranteed, the market often moves the other way first. Not forever. Not necessarily as a reversal of the long-term trend, but enough to shake confidence and force weak hands out. It's also important to separate short-term price action from long-term value. Silver can have strong fundamentals and still experience brutal pullbacks. Those two things are not opposites. In fact, they often exist together. The strongest long-term bull markets are filled with painful corrections that punish impatience. Anyone telling you otherwise is selling comfort, not reality. Inflation fears have played a major role in silver's rise. As purchasing power erodes, people look for tangible assets. Silver benefits from that narrative, especially because it's both a monetary metal and an industrial one. Demand from technology, solar energy, and manufacturing adds another layer to the story. But even strong demand doesn't eliminate cycles, it just shapes them. One of the biggest mistakes people make during explosive moves is confusing confirmation with safety. When price is high and everyone agrees, it feels safer than when price was low and nobody cared. In reality, it's usually the opposite. Risk is highest when confidence is highest. That doesn't mean price must collapse. It means expectations have become fragile. If silver touches $100, the reaction matters more than the number itself. Does price hold above it with declining volatility and steady volume, or does it spike and immediately reject? Does buying continue after the headline, or does volume dry up once the excitement fades? These details determine whether 100 becomes a launch pad or a ceiling. Another overlooked element is the role of media. Financial media loves clean narratives. Silver hits 100 is a perfect headline. It attracts clicks, attention, and emotional engagement. But markets often move opposite to headlines. By the time the story reaches mainstream coverage, much of the move has already happened. That doesn't mean the trend is over, but it does mean the easy part may be behind. None of this means silver is doomed or that higher prices are impossible. It means price discovery is messy, non-linear, and often uncomfortable. Long-term trends don't reward impulsive decisions made at emotional peaks. They reward strategy, discipline, and understanding how markets actually behave under pressure. There's also a difference between believing in silver and being blind to risk. You can respect the long-term case while still acknowledging that short-term pullbacks are normal and even healthy. In fact, without corrections, markets become unstable. Sharp drops often reset leverage, flush weak positions, and create stronger foundations for future moves. The idea that silver must go straight from 94 to 100 and beyond without resistance ignores decades of market behavior. Every asset, no matter how undervalued it once was, faces resistance when expectations become extreme. $100 is not just a price. It's a test of psychology. If price struggles near that level, it doesn't invalidate the broader thesis. It confirms that markets are doing what markets always do: challenge certainty. The real danger isn't silver failing. The real danger is people overcommitting emotionally or financially because they believe a round number guarantees continuation. Patience is underrated, especially during exciting moments. Waiting for confirmation, pullbacks, or consolidation isn't weakness. It's respect for risk. The market doesn't reward urgency just because excitement is high. It rewards those who can remain calm when everyone else is loud. Silver's story isn't finished at $100, whether it reaches it now, later, or overshoots and pulls back. What matters is how participants respond, not how loudly they celebrate. Traps don't always look like crashes. Sometimes they look like euphoria followed by disappointment. If you're watching silver right now, the most important thing you can do is separate belief from behavior. Believe in your thesis if you've done the work, but behave with caution when emotions run hot. Markets punish certainty far more often than doubt. $100 may come. It may even break, but the idea that it's automatically a victory is dangerous. Sometimes the most obvious level is where the hardest lessons are taught, and the market has a long memory for those who confuse excitement with inevitability. In the end, silver doesn't move based on hope or fear. It moves based on supply, demand, positioning, and psychology colliding in real time. Right now, all eyes are on one number. That alone should make you pause. Because when everyone is watching the same door, the market often slips out the side. If you want to understand silver, don't focus on the headline. Focus on the reaction. That's where the truth always shows itself.